You know what drives me crazy? I see it every single day. Regular folks, teachers, doctors, nurses, engineers, throwing their hard-earned money at stocks they couldn't explain to their 10-year-old kid. Let me tell you a story that'll make your stomach turn. Back in the late 90s, I watched a dentist lose $50,000, $50,000, on companies he knew nothing about. He'd heard these hot tips at cocktail parties. Internet stocks are going through the roof. Get in before it's too late. So he did. He bought shares in businesses he'd never use, selling products he didn't understand, with business models that made zero sense. And you know what happened? He got absolutely killed. Here's the thing that kills me. This wasn't some Wall Street shark. This was a smart guy, a professional, someone who spent years learning his craft, but when it came to investing, he threw all that common sense out the window. Stay with me here, because I'm going to show you why buying stocks you don't understand is the single biggest mistake you can make as an investor. And more importantly, I'm going to give you the exact framework I used to turn $11,000 into $2 million managing Fidelity Magellan, not because I'm some genius, but because I followed one simple rule. Only invest in what you know. Let's talk about the dumbest way to lose money. You're at a barbecue. Your neighbor leans over. Psst, I've got a hot tip. XYZ Tech is about to explode. My brother-in-law works there, and just like that, you're thinking about it. Maybe you're even pulling up your phone to check the stock price. Stop right there. Here's what you need to understand. By the time information reaches you at a barbecue, the market already knows about it. That stock price already moved. You know what you're doing when you act on these whispers? You're buying high. You're showing up late to the party after everyone else already left. But there's something even worse about hot tips. They're lazy. They let you skip the most important part of investing, understanding the actual business. When someone hands you a stock tip, they're not handing you the company's story. They're not explaining how it makes money, what its debt looks like, who's running it, or whether its best days are ahead or behind it. They're giving you a name and a prayer. I ran $13 billion. Not 13 million, 13 billion. And you want to know how many hot tips I acted on? Zero. None. I didn't care what some CEO whispered at lunch. I didn't care what the analysts on Wall Street were saying. I cared about one thing. Does this company have a story that makes sense? If you can't explain in 2 minutes why a company will earn more money next year than this year, you have no business owning that stock. Period. Here's something that's going to sound crazy. You, yes, you, have a built-in advantage over professional money managers. I'm serious. Wall Street doesn't want you to know this. They want you to think investing is complicated. They want you intimidated. They want you paying them fees to manage your money because you think you're too dumb to do it yourself. That's garbage. You know why you have an edge? Because you live in the real world. You shop at real stores. You use real products. You see what's working and what's dying before it shows up in some analyst report. Let me give you an example. Say you're a teacher. You walk into Staples every August to buy supplies for your classroom. You notice the place is packed, lines out the door, shelves getting emptied. Meanwhile, the office supply store down the street looks like a ghost town. That's valuable information. That's the kind of insight that doesn't show up in earnings reports until 3 months later. You're seeing it right now, in real time. Or maybe you're a parent. You notice every kid at the playground is wearing the same brand of sneakers. You ask around. Turns out this brand is all anyone talks about. The store can't keep them in stock. That's not just a trend. That's a company that might be growing fast. This is what I call being a story investor. You find the story before Wall Street does. But here's the catch, and this is huge. You still need to understand the business. Seeing a busy store isn't enough. You need to know, is the company profitable? Is it loaded with debt? Is this growth sustainable or just a fad? Can they expand or are they tapped out? That's the difference between investing and gambling. Let me break down something that'll change how you think about every stock you touch. Not all stocks are created equal. There are 6 categories, and each one behaves totally differently. If you don't know which category your stock falls into, you're flying blind. Slow growers, these are big, boring companies that grow maybe 2 or 3% a year. Think utilities. They're stable, they pay dividends, but don't expect them to double your money. You buy these for income, not excitement. Stalwarts, these are your Coca-Colas, your Procter & Gamble's. Solid companies growing 10 to 12% a year. You're not going to get rich quick, but you're not going to lose your shirt either. They're good for protection when markets get choppy. Fast growers, now we're talking. These are small, aggressive companies growing 20, 30, even 50% a year. This is where you make real money. A stock that grows earnings 25% a year for 5 years turns into a 3-bagger. Find one early and you might snag a 10-bagger or even a 20-bagger. But here's the warning. Fast growers are risky. They can fall apart overnight if something goes wrong. Cyclicals, these are the stocks that make people rich and broke in the same lifetime. Car companies, airlines, steel manufacturers, they boom when the economy booms. They crash when the economy crashes. Timing is everything, and timing is nearly impossible. Turnarounds, companies that were left for dead but might come back, they're high risk, high reward. If you catch one at the bottom, you can make a fortune, but most of them stay dead. Asset plays, companies sitting on something valuable that nobody's noticed yet. Maybe they own real estate, or patents, or natural resources. The market hasn't priced it in yet. These are rare, but when you find one, they're gold. Now here's what kills me. Most people never bother figuring out which category their stock belongs to. They buy a cyclical at the top thinking it's a growth stock. Or they buy a slow grower expecting it to double in a year. You've got to know what you own. Let me give you the simplest, most powerful tool you'll ever use as an investor. I call it the 2-minute test. Here's how it works. Pretend you're explaining the company to a 10-year-old. You've got 2 minutes. Can you explain what the company does, how it makes money, and why it's going to make more money in the future? If you can't, don't buy the stock. I'm not kidding. This isn't some dumbed-down version for beginners. This is what separates people who make money from people who lose it. Let's try it. Say you're looking at McDonald's. What's the story? McDonald's sells hamburgers and fries all over the world. They don't actually run most of their restaurants. They franchise them. That means they collect money without much risk. They're opening new stores in China and India where millions of people are eating fast food for the first time. Their earnings should grow as they open more stores. Boom, done. That's a story that makes sense. Now let's try a company you don't understand. Say some biotech firm. What's the story? They're working on some drug for a disease I can't pronounce. It's in phase 2 trials, whatever that means. The stock could go way up if the FDA approves it, but I don't really know how drugs get approved, or what happens if this one fails, or whether the company has any other products. See the difference? One of those is an investment. The other is a lottery ticket. If you can't pass the 2-minute test, it means you don't understand the business. And if you don't understand the business, you're going to panic and sell at exactly the wrong time when things get rocky. Let me tell you about the single best investment I ever made, Dunkin' Donuts. You know how I found it? I bought coffee there every single morning. I noticed the line was always long. The coffee was cheap and good. People loved it. I started paying attention. They were opening new stores. The brand was expanding. The economics made sense. Coffee costs pennies. They sell it for a couple bucks, and people come back every single day. That's it. That's the big secret. I didn't need insider information. I didn't need some analyst report. I just paid attention to what was right in front of me. This is the edge you have. You experience the economy every single day. You know which restaurants are packed and which are empty. You know which products your kids beg for and which ones collect dust. You know which stores you love and which ones you avoid. That's better information than 90% of what Wall Street is peddling. But again, and I can't stress this enough, noticing something is just the beginning. You still need to do the homework. Let me walk you through what that means. When I say do your homework, I don't mean read a bunch of fancy reports full of jargon. I mean answer a few simple questions. Question 1, what's the company's story? How does it make money? Is that story simple or complicated? Simple is better. If you need a PhD to understand the business model, move on. Question 2, what are the earnings? Are they growing? Have they grown consistently over the past few years? If earnings aren't growing, the stock isn't going anywhere. Question 3, what's the debt situation? Does the company owe a ton of money? High debt is a red flag. It means the company is vulnerable. If business slows down, they could be in serious trouble. Question 4, what's the P/E ratio? That's price to earnings. It tells you how expensive the stock is relative to what the company actually earns. A high P/E means everyone expects big things. A low P/E might mean you're getting a bargain, or it might mean there's a good reason nobody wants it. Question 5, who's running the company? Do the executives have a track record? Have they grown other businesses? Do they own a lot of stock themselves? If management has skin in the game, that's a good sign. Question 6. What's the growth plan? Is the company opening new stores, expanding to new markets, launching new products? Growth doesn't happen by accident. There needs to be a clear plan. You can find all of this information for free: company websites, annual reports, stock screeners. It's not hidden. It's just sitting there waiting for you to look. But most people don't bother. They buy based on gut feeling or a headline they saw, and then they wonder why they lose money. Here's what blows my mind. People will spend 3 weeks researching which dishwasher to buy. They'll read reviews, compare features, check prices at 5 different stores. We're talking about a $400 purchase. But then they'll throw $10,000 at a stock they heard about on TV without spending 10 minutes understanding what the company actually does. Does that make any sense to you? It shouldn't. Let me tell you what happens when you buy stocks you don't understand. The stock drops 10%. You panic. You don't know if this is normal volatility or a sign of serious trouble. Because you never understood the business in the first place, you have no framework for evaluating what's happening. So you sell. You lock in your loss. Then 2 months later, the stock is back up. You missed the recovery because you didn't have conviction. And you didn't have conviction because you never did the homework. Now let's contrast that with someone who understands their investment. The stock drops 10%. They look at the fundamentals. Did earnings change? No. Did the debt situation get worse? No. Did the growth story fall apart? No. Then what happened? The market overreacted to some temporary news. This investor knows the business is still solid, so they hold. Maybe they even buy more. 6 months later, they're up 30% while the panic seller is still licking their wounds. That's the power of understanding what you own. It gives you the confidence to ride out the noise. And in investing, the noise will kill you if you let it. The market is full of noise. Every single day, there's some new headline designed to make you panic. Interest rates are going up. Interest rates are going down. Inflation is coming. Recession is coming. Trade wars. Elections. Natural disasters. If you let every piece of news scare you out of your positions, you'll never make money. But if you understand the business, you can separate signal from noise. You can ask, does this news actually change the long-term outlook for this company? Most of the time, the answer is no. And that means you hold tight and let your winners run. Here's another thing people get wrong. They think they need to find the next Amazon or the next Apple. They want to hit a home run on some unknown company that'll make them rich overnight. That's not how this works. You know what most of my best investments were? Boring companies, tire companies, auto parts stores, supermarkets, companies that did one thing and did it well, companies I could understand. You don't need to be a genius to make money in stocks. You don't need to predict the future. You just need to find good companies selling at reasonable prices and hold them while they grow. That's it. It's simple, but it's not easy because it requires patience, it requires discipline, and it requires you to actually understand what you own. Let me tell you about one of the worst mistakes I see. People diversify into things they don't understand because someone told them diversification is important. So they buy a little of this, a little of that. Tech stocks, biotech, commodities, foreign stocks, crypto. They end up with a portfolio of 30 different things and they don't understand a single one of them. That's not diversification. That's confusion. Real diversification means owning several good companies in different industries that you understand. 5 to 10 solid investments that you've researched and believe in beats 30 random stocks you know nothing about. Here's a test. Could you explain to someone why you own each stock in your portfolio? Not because I think it'll go up. That's not a reason. I mean the actual business case. If you can't, you need to do one of two things. Either learn about those companies or sell them and invest in things you do understand. Let me give you a real-world example of how understanding a business saved me from a disaster. Back in the 80s, everyone was excited about disk drive companies. They were high-tech. They were growing. The stocks were going through the roof. But when I looked closer, I realized something. The technology was changing so fast that today's winner could be tomorrow's loser. Plus, there were too many competitors. And the customers, computer companies, had all the power. They could squeeze the disk drive makers on price. The business model was terrible, so I stayed away, even though everyone thought I was crazy. Within a few years, most of those companies were either bankrupt or worth a fraction of their peak value. That's what understanding the business does for you. It helps you avoid disasters, not just find winners. And avoiding disasters is half the battle. If you can just avoid the big mistakes, you're already ahead of most investors, because most investors blow themselves up by chasing things they don't understand. Now, let me talk about something that drives me absolutely crazy. The idea that investing is about predicting the future. It's not. Nobody can predict the future. Not me, not the experts on TV, not the hedge fund managers, nobody. Anyone who tells you they can is lying. What you can do is understand a business today and make an educated guess about whether it'll be better or worse in 5 years. That's very different from predicting next quarter's stock price. When I look at a company, I'm not trying to predict where the stock will be next month. I'm asking whether this business will be stronger 5 years from now. Will they have more customers? Higher earnings? Better competitive position? If the answer is yes, and the price is reasonable, then I'm interested. If the answer is no, or if I can't figure it out, then I move on. It's that simple. Here's what's interesting. The market is full of people trying to predict short-term movements. Where will the stock be next week? Next month? Next quarter? All that effort, and they're basically just gambling. Meanwhile, the people who focus on long-term business quality are the ones who actually make money, because over time, stock prices follow earnings. If a company grows its earnings consistently, the stock price will eventually follow. It might take a year, it might take 5 years, but it will happen. That's why understanding the business is so important, because if you understand the business, you can focus on the right thing, which is long-term earnings growth, not short-term price fluctuations. And that's the difference between investing and trading. Trading is about predicting short-term movements. Investing is about owning good businesses for the long term. One is gambling. The other is wealth building. Let me tell you about another mistake I see all the time. People buy stocks based on stories they want to believe instead of facts. They hear about some revolutionary technology that's going to change the world. They get excited. They invest. But they never check whether the company is actually making money or whether it ever will. Hope is not an investment strategy. You need to see actual results, actual earnings, actual growth. If a company's been around for 5 years and still isn't profitable, that's a red flag, not an opportunity. Now, don't get me wrong. I'm not saying you should only buy profitable companies. Sometimes you find a young company that's reinvesting everything into growth. That can work. But you need to understand the plan. How will this company eventually make money? When? What needs to happen? If you can't answer those questions, you're speculating, not investing. Here's a good rule of thumb. If the investment thesis depends on everything going perfectly, it's too risky. Good investments work even when things don't go perfectly. They have a margin of safety built in. That might mean low debt so the company can survive a downturn, or it might mean multiple growth drivers so if one fails, others can pick up the slack. Or it might mean strong competitive advantages that protect the business. The point is, you want to invest in companies that can handle adversity, not companies that need perfect conditions to succeed. Let me give you another practical example. Say you're looking at a restaurant chain. They're opening new stores rapidly. The stock is hot. Everyone's talking about it. Before you invest, you need to ask some hard questions. How many locations can they realistically open before they saturate the market? What's their competition doing? Are food costs going up? How's management? Do they have experience scaling a restaurant business? What happens if the economy slows and people eat out less? If you can't answer these questions, you don't understand the business well enough to invest. And that's okay. There are thousands of stocks out there. You don't need to invest in every opportunity. You only need to find a few good ones that you actually understand. Here's something that might surprise you. Some of the best investments I ever made were companies that had temporary problems. Everyone else panicked and sold. The stock got cheap. But I understood the business well enough to know the problems were fixable, so I bought while everyone else was running away. That's what understanding a business allows you to do. You can spot the difference between a temporary setback and a permanent disaster. But if you don't understand the business, you can't make that distinction. A bad quarter looks like the end of the world. You panic and sell at the bottom. Then you watch the stock recover without you. This happens over and over to people who invest in things they don't understand. Let me talk about technology stocks for a minute, because this is where people get themselves in the most trouble. Technology changes fast. What's hot today is obsolete tomorrow. Unless you work in the industry or have deep knowledge, tech stocks are dangerous. I'm not saying don't invest in technology. I'm saying only invest in tech companies you actually understand. Can you explain how the company makes money? Do they have sustainable competitive advantages? Are they dependent on one product, or do they have multiple revenue streams? What happens if a competitor comes along with something better? These are hard questions, and if you can't answer them, stay away. Here's the thing about technology. The best tech investments are often the boring ones. Companies that provide infrastructure, companies that have sticky customers, companies where switching costs are high, those are the ones you can understand and evaluate. The flashy ones with revolutionary technology that nobody can explain, those are the ones that blow up portfolios. Let me give you a framework for thinking about any investment. I call it the 5-minute drill. Spend 5 minutes trying to explain the investment to someone who knows nothing about it. If you can't do it clearly and convincingly in 5 minutes, you don't understand it well enough. This works for stocks, bonds, real estate, anything. If you can't explain it simply, you don't get it. And here's the kicker. If you don't get it, you definitely shouldn't invest money in it. This seems obvious, but you'd be amazed how many people ignore this rule. They invest in complex derivatives, structured products, exotic strategies, all kinds of stuff they don't understand. Then they act surprised when it blows up in their face. Stick to what you know. It's the most important rule in investing. Warren Buffett built a fortune on it. I built a career on it. And you can build wealth on it too. But you have to actually follow it. That means passing on opportunities you don't understand, even when everyone else is making money. It means being patient until you find something in your wheelhouse. It means doing the homework before you invest, not after. Let me tell you what happens when you follow this rule. You sleep better at night because you understand what you own. When the market drops, you don't panic. When some talking head on TV says the sky is falling, you can evaluate whether that actually affects your investments. You have confidence, and confidence in investing is worth more than any hot tip. Here's another benefit. You'll avoid frauds and scams, because when you don't understand something, it's easy for someone to snow you with fancy talk. But when you demand clear explanations and actual evidence, the scammers can't operate. They need confusion to thrive. Clarity is their enemy. Think about every major fraud in investing history. Enron, WorldCom, Madoff. All of them relied on people not understanding what was actually happening. The investments were complex. The explanations were confusing. And people invested anyway because they didn't want to admit they didn't get it. If those investors had followed the simple rule of only investing in what they understand, they would have avoided disaster. So how do you get better at understanding businesses? You practice. You read. You pay attention to the world around you. Every time you shop, eat out, buy something, use a service, ask yourself questions. Is this company growing? Why? What's their competitive advantage? Could I invest in this? Would I want to? The more you think like an investor in your daily life, the better you'll get at spotting opportunities. Read annual reports. I know they're boring, but they're gold mines of information. Management explains the business, the strategy, the risks, the financials. Everything you need is in there, and if you read the annual report and still don't understand the business, that tells you something important. It means you should pass. Talk to people who work in industries you're interested in. They have insights you'll never get from reading. They know which companies are well run and which are disasters. They know who's gaining market share and who's losing. This is valuable intelligence. Visit the companies you're thinking of investing in. If it's a retailer, go to the stores. Are they clean, well-stocked, busy? If it's a restaurant, eat there. Is the food good? Is service good? Are people coming back? If it's a manufacturer, see if you can tour a facility. The more you see with your own eyes, the better you'll understand the business. Here's what I want you to take away from all this. Investing isn't complicated, but it does require work. The work isn't reading complex theories or learning fancy formulas. The work is understanding businesses. And the first rule of understanding businesses is being honest with yourself about what you do and don't know. If you can't explain a business simply, you don't understand it. If you don't understand it, you shouldn't invest in it. This rule will save you more money than any other piece of advice you'll ever get, because it will keep you out of disasters, it will keep you focused on real opportunities, and it will give you the confidence to hold through volatility because you understand what you own. Stop buying stocks you don't understand. Start doing your homework. Find businesses you can actually explain and evaluate. Invest in those. Hold them for the long term, and watch your wealth grow. It's not exciting, it's not glamorous, but it works. And at the end of the day, That's all that matters. You don't need to be smart to succeed at investing. You don't need inside information. You don't need fancy tools or complex strategies. You just need common sense and discipline. Understand what you own. Invest for the long term. Ignore the noise. That's it. That's the secret. And it's been sitting right in front of you the whole time.